Ladies and gentlemen, thank you for standing by. This is the event operator. Welcome to Barrick's results presentation for the second quarter of 2024. Following today's presentation, a question-and-answer session will be conducted. If you have a question and are joining the event by telephone, please press star, then 1 on your telephone keypad. We will also be taking questions from those in the room. As a reminder, this event is being recorded and a replay will be available on Barrick's website later today, August 12, 2024. I would now like to turn you over to Mark Bristow, President and CEO of Barrick. Please go ahead, sir.
Thank you very much, and very good morning and good afternoon to those here at the Barrick corporate office and across the globe. Welcome to the Quarter 2 results presentation. So at the halfway mark of 2024, it's gratifying to report that our performance has been picking up as we work to meet our production guidance for the year. As important as our operations is the progress we are making in advancing our major growth projects. As I will show you during this presentation, a new potential Tier 1 gold mine, 100% owned by Barrick, is taking shape in Nevada. Our copper business is on track for a transformative expansion, and the enlarged and upgraded Pueblo Viejo is getting into its stride for a new 20-year stretch as a world-class producer. These mines will be delivering new gold and copper into the market at a highly opportune time, demonstrating the value of Barrick's long-term planning and investment strategy, as well as the enormous upside optionality embedded in our asset base. This is the customary cautionary notice regarding forward-looking information, and for those who want to study it further, you'll find it in full on our website. Starting with the group highlights, the safety, financial, and operational results for the past quarter all point in the right direction, reflecting a business that is delivering across the board. Rising production and increasing margins provide the foundation for a strong second half, while the financials augur well for our ability to fund our growth and so sustain the delivery of value to our shareholders. Here is a closer look at the financials. Particularly significant are the increase in attributable EBITDA margin to 48% and the substantial free cash flow growth. Gold margins were up 39% quarter on quarter, while copper margins rose by 124%. Adjusted net earnings per share were 68% higher quarter on quarter, and debt net of cash was reduced by 12%. And the share buyback program was restarted and the quarterly dividend maintained at 10 cents per share. Operationally, gold production increased slightly quarter on quarter. Slightly higher costs were a function of higher royalties, but for all intents and purposes, the costs were flat. And the drivers of the costs were really sit with PV as we ramp it up, and then the pushbacks in Carlin and Cortez. Copper production increased, with costs falling thanks to higher grades and mining fleet upgrades. And looking ahead, we expect materially higher production from PV, Turquoise Ridge, and Lumwana into the second half of the year. If you look at our detailed health and safety report, it's very pleasing to show you how that the performance continues to trend positively as we pursue our zero harm goal. Our approach to sustainability has always been holistic and embedded in our business. It is a differentiated approach focused on the long term and the understanding that all environmental and social aspects are interconnected and integrated. Our approach is always based on science, and it needs to be measurable. This is why we developed the industry-first sustainability scorecard to track and disclose our sustainability performance. We also link our targets and reports to the UN Global Compact and the UN Sustainable Development Goals, or SDGs, which itself calls for an approach to sustainability that resonates with our strategy. And that is why we have developed and launched our own comprehensive biodiversity assessment tool during the past quarter. It is designed to measure our impacts on nature and inform actionable conservation strategies, and in time to come, targets to measure against, while maintaining a human-focused lens for the development of our host communities in our goal to alleviate poverty. Our integrated approach extends to our climate change strategy, and the addition of 200 megawatts of renewable solar energy at the TS power plant in Nevada is another contributor. So we start the operational review, as usual, in North America, where Nevada Gold Mines hosts 3 of our Tier 1 mines, with another in the making at the adjacent 100% Barrick-owned 4 Mile project. 4 Mile is a particularly exciting prospect. The more we learn about it, the more it looks like it could be the largest undeveloped high-grade gold deposit in the world today, directly adjacent to Nevada Gold Mines' existing infrastructure in one of the world's best mining jurisdictions. Following the completion of the Sage autoclave maintenance shutdown in the first quarter, Turquoise Ridge increased in production by 16%, while Carlin focused on underground development to improve its operational flexibility to offset the Gold Quarry pit redesign following the pit wall failure in Q1, and Gold Rush continued to ramp up at Cortez. With that, let's take a closer look at 4 Mile, which is adjacent to Gold Rush, but as I said in the previous slide, is 100% owned by Barrick. I'm going to pause here so that you can digest the very significant intersections by the 10 diamond core drill rigs currently on site. If you look at these drill intersections, they really remind one of yesteryear, the gold strikes, the Carlins, the big discoveries. And, many are in the 2 ounce per ton category. Really, 4 Mile reminds me of those company-making Carlin deposits of the past, a world-class project in every sense. As we shared with you last quarter, we're planning to have an updated mineral resource towards the end of the year, when we'll make a decision about the pre-feasibility options. But as I said, this is really one of those assets that geologists dream about. In the fullness of time, I believe this asset has the potential to be as valuable to Barrick as our current stake in Nevada Gold Mines. And that's before our geologists find more of those Carlin elephants that I keep talking about. And that takes me to the 14 million ounce Leeville project, which, like Gold Rush, is developing into another major growth driver with the potential to double or triple current reserves, extending Carlin's life beyond 2045. And I think this is significant, just to dwell a little bit further on it. And when you look at what we're dealing with today, we did a number of transactions in 2019, 2020. We never paid a premium for any of them. Embedded in those transactions are these types of ore bodies. And what we're doing now is bringing them to the fore and working to get them into our production profile. And you'll see more of this as you go. But just to before I leave North America and Nevada in particular, so we've got Gold Rush driving Cortez complex. We've got the emerging Leeville expansion driving Carlin. And of course, Turquoise Ridge stands on its own as a high-cost, high-grade, low-cost producer. And really, that is the future of Nevada. And then when you see the sort of quality coming out of 4 Mile, you've got to believe that there's more opportunities to make new discoveries in this region, and that's our focus. So, leaving the North Americas, we move now to Latin America and the Asia-Pacific region, where our flagship growth project, the Pueblo Viejo plant expansion and mine extension, is up and running again. In Papua New Guinea, the recently restarted Porgera mine is ramping up to commercial production, while in Pakistan, the Reko Diq feasibility study is on track for completion this year. Work has already started on the construction of what we term early works infrastructure, while a recruitment drive focused on employees from the Balochistan province, which is the very foundation of on what we're going to build Reko Diq. Just a reminder that the Pueblo Viejo project is designed to increase annual production sustainably above 800,000 ounces for 20 plus years. After the failure of the conveyor infrastructure last year, it has now been rebuilt, and the focus over the past 3 months has been on throughput. For the third quarter, attention is now on grinding, flotation, and recovery, ramping to achieve design output parameters. In the meantime, work on the new El Naranjo tailings storage facility is advancing as planned. Here you can see how the project has advanced over the past 12 months and the outlook for the remainder of the year. Now to Africa and Middle East region, which delivered its usual reliable performance with steady production and well-contained costs. These are the highlights, and I'll tell you more about them as we go along. Another steady quarter for Loulo-Gounkoto, with cash costs well contained and all-in sustaining costs impacted by additional stripping for the Yalea pit pushback. Positive results from ongoing brownfields exploration point to further life of mine extension opportunities. And as we indicated last quarter, we continue to engage with the government of Mali on their desire to increase their benefits from the mining industry while protecting our rights and the economic viability of the Loulo-Gounkoto complex going forward. In the north of the Loulo permit, drill results from the Boboto target have identified a large-scale, well-endowed system with high-grade intercepts. This, along with other near-mine targets, augurs well for Loulo-Gounkoto to again replace the gold they mine this year. And across to the DRC, where Kibali picked up speed after a slow start to the year with waste stripping providing access to higher grade open pit ore. Meanwhile, next year's planned commissioning of its solar power and battery storage facility will complement the mine's 3 hydropower plants, increasing the renewable component of its energy use to 85%. And in fact, for 6 months of the year, we'll have 100% renewable energy driving our power delivery. As at Loulo-Gounkoto, brownfields exploration continues to deliver further potential for growth, with high-grade results from the Agbarabo, Rhino, Kumbakola targets pointing to a significant deposit within just 4 kilometers of the plant. The prolific KCD trend is also producing new opportunities for reserve additions, and therein lies the quality that what we, everyone sort of created a definition of tier 1 assets, but real tier 1 assets come with enormous upside opportunity, as you see in Loulo-Gounkoto and at Kibali and significantly in Nevada. In Tanzania, North Mara and Bulyanhulu both increased production while driving down costs, and the resuscitation of these mines is one of our major success stories, as is the concept of formal benefit-sharing partnerships with host countries, which we successfully pioneered with the Tanzanian government. The Lumwana copper mine in Zambia delivered a higher production at lower costs in line with the plan and is set for an even stronger second half of the year. The mine is also on the threshold of its super pit expansion, which will increase production to some 240,000 tons of copper and extend the operations life by more than 30 years. First production of this project is expected, or from this project is expected in 2028. The Lumwana Super Pit and Reko Diq are two of the organic growth projects I referred to at the start of the presentation, and which are recapped here. Together, they will provide powerful support for Barrick's drive to grow our gold equivalent production by 30% during this decade. And it's worth reminding you that Reko Diq will be both a gold and a copper mine, designed to produce 400,000 tons of copper on an annual basis and 500,000 ounces of gold per year in phase 2 of its development. Add to that the ramp-up of basically 2 new mines, Goldrush and PV, to be followed by a potential brand new mine in 4 Mile, of which Barrick owns 100% and which can utilize the existing Nevada Gold Mines infrastructure and processing facilities. Barrick has an unmatched growth portfolio that separates us from the industry, with prospects of even more to come from our ongoing exploration initiatives. So, this brings me to a subject I have been flagging for some time, and that is how undervalued Barrick's shares are today. So to end my presentation, I wanted to take you through some research based on consensus net asset value of our assets. On this slide, we highlight 2 of our key businesses. On the left of the slide, you have Nevada Gold Mines, which is by far the best gold asset in the world's most mining-friendly jurisdiction. The right side shows our growing copper business is well on track to becoming world-class amongst peers, some of which have recently attracted international attention. Moving one step further, this table identifies the unrealized value embedded within Barrick's portfolio. Nevada Gold Mines on its own should command the industry's highest valuation. On that basis, this analysis conservatively assumes the price to NAV multiple equivalent to that of Agnico Eagle, although arguably NGM would be higher rated given its size and quality. The analysis applies a similarly conservative market multiple to our copper assets, in line with copper peers, although again I would note that the recent BHP Lundin transaction ascribed significantly higher multiples to those undeveloped copper assets in Argentina. Again, the analysis is based on the current analysts' consensus NAVs, but we expect these NAVs to increase as we will be publishing updated feasibility studies on our two key growth projects at the end of the year. As you can see from the table, on the basis of the analysis, the value of just our interest in the Nevada gold mines and our copper portfolio alone exceeds our current market cap. In fact, according to the current market value of our shares, the rest of our business has a negative value of $1.2 billion. This includes our interest in 3 Tier 1 gold mines outside Nevada, the world-class 4 Mile project, other gold mines and development projects still in the pipeline, and our exploration team's unparalleled success in uncovering new answers. In short, I would submit that when you buy Barrick today, you get a lot for free. We set out in 2019 to build a sustainably profitable gold and copper mining company focused on world-class assets. We did not have to buy them at a premium, as I indicated in my introduction. They were embedded in the combined portfolio that we put together at market and just required identification, evaluation, development, and delivery, which is where we are today. On top of that, we have replaced all the ounces we have mined and repaired our balance sheet to be industry-leading and capable of supporting our dividend policy and growth plans. Clearly, Barrick represents an investment opportunity unmatched in our sector, and I hope you will leave the presentation with a clearer understanding of why the case for such an investment is so compelling. Thank you all for your attention, and we'll be happy to take questions as usual. Where do you want to start? Here, in the order. Okay.
Mark, thanks very much for the presentation. It's Lawson Winder from Bank of America.
Hello, Lawson.
I wanted to start on copper and just ask about Lumwana. So two questions on that particular asset. So one, the power situation in the country. I mean, currently there's been a reduction of 20% initially and now 40% for electricity availability. Do you anticipate that will continue to improve going forward? Is there any risk that that could be reduced further? And then secondly, when you think about the Lumwana project ramping up and first production in 2028, what is the latest thinking on a power solution for that asset?
So there are, Lawson, there are some plans to put extra infrastructure, power infrastructure into Zambia. We have already been awarded the capacity required to bring in the expansion in Zambia. So technically, we're cleared to draw off the grid as the country itself looks to expand its infrastructure. At the same time, Barrick has recently completed a study of the entire Zambian power infrastructure and potential. And of course, we share that with the authorities. And then as far as the short-term issues go, you're right, 40% is now the rationing, but we have got a back-to-back agreement with the utility to be able to purchase third-party power from outside Zambia at a discount to the cost of generating diesel power, and we've got full backup diesel power on site as well. So having said that, and so we saw this coming, we invested in our own insurance. We then worked with the government to make sure that we can access additional external third-party power at a lower price to what we generate ourselves. But at the same time, we brought in additional infrastructure and generating equipment to be able to support ourselves. And as part of that, we've also reached agreement on cogeneration. So we can generate power ourselves and feed it through the grid. So we've done pretty much we grew up in West Africa where you have to rely on your own self to be able to supply power. And so, the AME team is, very equipped to be able to deal with this stuff. Having said that, there's of course challenges. We every now and then we get the power delivery unsynced, and we have to pick up on it. But we're getting much better at being able to do that. And so at this stage, we don't believe that in the medium to long term that there's a risk, but we will continue to look at solutions. And of course, as you know, we've just commissioned the TS solar plant in Nevada. That's 200 megawatts. So, if you look back to our experience, going back to Randgold days, we started with generating diesel, then we went into heavy fuel, now we gas turbines, solar. So we have a very good technical capability of managing power. And the first thing is to work with the utility to make sure that, one, they understand the opportunities and the infrastructure, because it's no good just dumping in power like you saw in Pakistan, where they've got lots of power, but they can't get it anywhere because the infrastructure is unreliable. So that was our first investment alongside or on behalf of the Zambian government. So, we're very aware of it. We are not dismissing it. We recognize it as a risk. But once once you understand it, then you can work to mitigate it.
At RBC. Mark, if I can ask you a question on capital allocation. I think historically you've talked about prioritizing or wanting to prioritize financial liquidity for some of the copper growth portfolio, development capital. The company now has started a little bit of a buyback. Is it reasonable to assume that this could continue from here, or is this sort of a one-off thing?
No. First of all, Josh, just to correct you on your report this morning, we put in the buyback approvals so that we can manage shorts in the market and any softness in the stock. So our discipline is real, and you've seen that through my whole career. I don't say one thing and do another. And so managing capital allocation is core to us. And so the way our model works, which we've shared with our investors, is when we get extra cash net of debt, we will pay that as a dividend. As management, we've got the flexibility as we go towards that point of using that money to buy back stock. And so then you delay the dividend. And and we will manage it against how we deem the value of the shares. And right now, there's no question that the shares are a good buy. And so, we got through some of our challenges at the earlier part of this year. We had some extra cash. We had a window because, remember, we have closed periods where we can't buy. And again, what we said in the press release is we restarted our share purchase, and we'll do that within that guidance that we've shared with the market. And I would also point out, if you look at Barrick and its returns through dividends, share buybacks, return of capital, we're not out of kilter with our peers. and we still got a very strong balance sheet. And so if you look at the returns, particularly given the current share price, the returns are quite healthy against the equity. But our objective will be, first of all, get the share price up. That's the real focus. And in the long term, we'll pay the dividends as I did in Randgold Resources, and we fundamentally believe that dividends should come from the P&L in a mining company like Barrick. And you shouldn't be borrowing to pay dividends. And that's the way we've always run our businesses, and that's the way we plan to continue. And just probably another bit of color. This quarter is good because you see the costs are flat. Okay, on the swings and roundabouts, there are a couple of assets that still have a way to go, and there are other assets that are ahead of the curve, like PV's got some way to go, and Turquoise Ridge as well. But largely, we're at that point where we're now starting to, we've caught up with a lot of the development. We're starting to transition to our own teams, back to our own teams from the contractors on the development, particularly in Nevada, to catch up and build that flexibility in the underground operations. And a lot of that supporting capital, the sustaining capital you call it, that starts coming off as we forecast now for a while. And it gets replaced by a growing growth capital as we go into the expansion of Lemoine and the construction of Reko Diq. And then, of course, 4 Mile is a brand new asset. It's still at that pre-feasibility stage. And we need to get our head around that. But you can see how quickly the geology started to link together. And so that's another opportunity. And then the remaining capital in Pueblo Viejo is all about the tailings facility. The capital itself for the expansion is largely spent.
One more question on sort of the same train of thinking you were reviewing. I do like the slide you had that demonstrates the value proposition with the stock here, and sort of the real core value drivers. I'm wondering, in the event that shareholders or investors don't recognize that, would the company ever consider, spinning out some assets or, divesting some of these non-core positions to try to realize the value on a quicker time frame?
Well, first of all, have you ever seen that work? Getting rid of non-core assets, absolutely, very logical. But moving high-quality assets out of a portfolio makes no sense. First of all, the mining industry's got too many companies with not enough management as it is. And, breaking these companies up without a third-party acquisition by competent management is a challenge to deliver value. And that's a short-term opportunity. It's like people saying, so why don't you delay the capital development of your assets and give us the dividend? So how do we build the company? Because it's a consumptive industry. You've got to replace what you mine. And I would take you back to 2 examples. We went through the same debate with the market in 2011 in Randgold. We ended up at over 2 times NAV, trading at over 2 times NAV eventually as we delivered on those assets. Another really good example is Freeport. We try to convince Freeport to merge with us when they were $10 billion market cap. They were resolute about their value of their company and the importance of investing in Grasberg's underground infrastructure. It took them years to get there. And they languished around the bottom end of value or under this value. But look where they're trading today. They delivered on that plan, and the markets recognize them, having been very negative to that decision to invest in that country, in Indonesia. So, and if you look at what grew BHP. It was those last century investments in high-risk developments, Escondida, the oil and gas, that really, the iron ore, that really built that company into what it is today. And that's what drove Rio to get where it is, and then it had a bad patch, and it's reflecting on how does it get back there. But it still made some big decisions in Mongolia. It's now, in West Africa. And so this world has moved that way. And if you want to play in the mining industry, and we've transitioned out of the mid-cap, lower-cap, instant gratification model. We're in there for the long term. We create a lot of value, and we know that this value delivers significant value for all our stakeholders. So that's the game that we've signed up in, to take this company back to where to the individual parts would not make any sense to certainly me. And I don't believe, when you look at our register, our main investors are all still very much intact from 2019.
Good morning, Brian MacArthur, Raymond James. So, Mark, you've highlighted how exciting 4 Mile might be, but can you just go over and review, because I suspect the devil's in the details now, how it gets vended in to NGM? And I guess the question really here is, I know you have to do a study, but technically, what type of study does it have to be? Can Newmont force you to do that study? Who controls the time horizon on that? Maybe just how you think about this going forward.
So let me cover the strategy, and then Graham, who actually negotiated the deal, I'll pass the detail to him. But there's nobody can force anyone to do anything in this life, and certainly not under this agreement. The point is, as you know, we have a partnership with Newmont in Nevada, and we have the right to access and utilize Nevada Gold Mines infrastructure, as does Newmont. And so at the end of the day, there's an opportunity to find a way to develop it in the best interests of both sets of shareholders, which is what we should be doing as custodians of these assets. At the same time, our responsibility, as all the time that 4 Mile remains 100% asset, is to maximize the asset for our shareholders. And so thus the work we're doing now is that we've got 10 rigs on site. You go there, it looks like the old days in Carlin. You got, just see rigs and trucks everywhere. And every intersection, as you see, is, multi-ounce intersections. And we're talking very thick, breccia style ore bodies. And so our work this year is really to get a feel of what it is. We don't make any secret of it. It's information we share freely, both with the market, our shareholders, and of course Newmont. And then once we've got that, we'll be able to have a better a view on our options. And there is a way to develop 4 Mile on a standalone basis. There's definitely a way to do it, but again, that's all in the optionality going forward and how we'll choose it. But getting back to the actual legal basis on which we can manage this, I'll pass it to Graham.
Thanks, Mark. So the joint venture agreement has specific provisions that deal with this. First and foremost, in terms of bringing the asset into the joint venture, provided that the joint venture meets a minimum return hurdle rate, it goes into the joint venture, and that would be on the back of a feasibility study. In terms of determining the value of the asset for the purposes of going into the joint venture, that is determined based on market valuation. So effectively, it would be consensus gold prices, a combination of consensus spot and recent history gold prices. and then importantly, market multiples for the appropriate asset. So it's very much a market-based valuation. And then on top of that, in terms of determining its value, it gets the benefit of all of the infrastructure that's already embedded. So effectively, the feasibility study doesn't carry any of the existing infrastructure. It simply looks at what the cost would be on a go-forward basis for that asset. So effectively, in the case of 4 Mile, it would benefit from all of the Gold Rush infrastructure that's already pre-developed. And then the cost of the feasibility study itself is also something that is part of the compensation. So in other words, on top of that market valuation. So that's the key aspects of it.
So just to clarify that, there's not much that's left behind in how everyone you pay full value for bringing it to feasibility, and then the value on the basis of the feasibility.
Hi, Mark. Anita Soni at CIBC.
Hello, Anita.
Good morning. My question is with regards to Pueblo Viejo. So you've got, thanks for the slide where it shows the recovery rates into the end of the year. I think you have a rebound of 79% and then 80% in Q3 and Q4 respectively. Could you just talk about how that evolves over 2025 as well? I think the targeted rates are around 92%, if I'm correct.
No, I think it's all just above 80. Is that correct? The final targeted recovery. Simon, are you on the call?
I'm here.
What's the targeted recovery rate for PV? Ultimately, or Mark Hill?
So it's an incremental over the next couple of years. We lift to 79 and then step up from there to the 80s.
Yeah. I don't think it's 92, but Mark, Mark Hill, are you on the call? Not on the hill. John Steele? John Steele?
Hi, Mark. I don't have the exact number in my head, but going up through mid-80s, 85 next year. I'm not sure of the exact number per quarter, though. I'll have to look that up and get back to you.
So that's the number I have in my head, the sort of mid-80s. And we're targeting, as you see, end of this year at 80, then 82, and the sort of 85, 86s. And Anita, the focus at the moment is, like I'm sure you've listened to this sort of line before many times in the mining industry. This is a single SAG mill, and then the original SAG mill with a ball mill, and getting those mills to optimize the grind, to optimize the float, to optimize the recovery. That's the focus that we're in right now, is balancing that. We're comfortable with the throughput. We're comfortable with the front end of the plant. It's now making sure that we've got the process control into the flow sheet, and now it's really teaching the process control to be able to optimize that balance between grind and not gritting up the circuit and the flotation. And I was there just the other day, and all the float cells are working. Everything's working now. It's just optimizing that balance. So the big focus was get the throughput to a point where we are comfortable with the ability to make that throughput, and now we're working on the optimization of the actual design criteria, which is recovery and flow and grind size, or grind the grind bracket, and not over grinding it or under grinding it.
Second question, both for Carlin and Cortez. The stripping rates picked up at Cortez, and I noticed in the MD&A it said it would be largely complete in mid-2025. So the rates that you're at about, I think it's 13 to 1, is that going to continue until Q2 of 2025? Is that the case?
Yeah, it'll come down. So look, Cortez is former Crossroads and Arturo. And that's the big focus on getting particularly Crossroads sorted out. And then and we're on top of that. The team has done an excellent job on getting their head around the Crossroads challenges, which were largely variations in the actual ore body between oxide and sulfide or refractory ore. And so, yes, it'll come off a little bit, but Cortez is, in my mind, is in good shape. The 7C failure in Gold Quarry Pit is the one that we're wrestling with at the moment, and that's a pit with a history of failures. And you remember, I think the 2009 failure, which was the sort of clay white part of the pit, which they used to call, I think, the phase 6. So right now we've got a pile of geotechs, and really you've got to go to the geotechs from Arizona and around there, not the geotechs from here, because it's completely different rocks, young, a lot of clay, a lot of water in the pit sidewalls, high hydrostatic pressure. So we're busy working with that now to redesign that pit. Short term is to be able to get back into the pit at the 7C position, and longer term is how does that pit look in the longer term life of mine, and how much do you have to lay it back, or can you design those sidewalls differently by dewatering the pit? And that's what we're looking at the moment. And so that we'll update you more on when we get to the end of the year.
So to round out the top 5, Turquoise Ridge, could you just give us a little bit more color on how the rest of the year evolves there? I did notice that the grades in the autoclave dropped, and I'm just not sure why that happened with the grades in the underground ramping up.
So Turquoise Ridge is all about backfill and putting in that infrastructure. So we made a conscious decision to slow down the mining, the mining and processing rate. We've got lots of stockpiles, so that's what you're seeing, and getting on top of the backfill infrastructure, and which we've done now. And now it's a case of catching up on the backfill so that we build full flexibility in the Turquoise Ridge mine plan. And the plan is that we will improve all the way out to the end of the year. That infrastructure catch-up plan is working, and we measure it weekly, and so I'm confident that we'll get back there by the end of the year. We'll have caught up the plan, and that's really the big. And Turquoise Ridge is a very high-grade ore body. It's got some upside opportunities in it, but if you don't keep your backfill up to speed right on the face, you have problems geotechnically. So, and that brings safety issues as well as flexibility in mining. So that's really the driver behind Turquoise Ridge.
Good morning. Thanks, Mark. This is Ralph Profiti from 8 Capital. I have 2 questions. Firstly, can you bring us up to date on your discussions with the Mali government? It seems like some of the peers are inching closer towards something that's more definitive in a positive way. Can you bring us up to date on that? And then secondly, you had talked about utilizing Nevada infrastructure on 4 Mile, and can you specifically address labor? How have you done in sort of the near term on addressing some of those constraints? And then eventually when 4 Mile does come into production, how does your long-term studies look on the labor constraints?
Okay, so So Mali, in the disclosure, it's pretty well where it is. As you know, we believe in sharing the economic benefits of a nation's asset that, as miners, we mine. No matter how you own it, my belief is that it's all national assets. And so when the junta took over, there was a view that Mali should benefit more from its mining industry. And as you know, there's no other industry that makes bigger contribution to the Mali economy than the mining industry. I've been in it since the very beginning. And of course, we're saying that's fine. We would be very happy to do that. We need to get down to the nitty-gritty and look at the models. We are still paying dividends. We paid a dividend 2 weeks ago, 10 days ago. And we are the biggest contributor into the Mali treasury. So the question that we have is, we're happy to do that on a percentage basis. So, slightly more than 50%, for example. That's a good place to be for a government. And also it has to be affordable by the company. That's Cote as a company. And what we are anxious about is we don't see any merit in paying huge amounts of future cash now, because it just makes the future more difficult to manage. So we need to work it in a transparent way. Our team is engaged with the President's Office, plus the Ministry of Finance and Ministry of Mines, and we're working constructively to find a way forward. And that's really all I can say at this stage. And we have been doing so for quite a while now. On the question around 4 Mile, just remind me? Labor constraints. Oh, yeah. So we've put a lot of effort into labor. Labor is critical everywhere today in mining. And we've just been through a restructuring. We took a whole level of management out of Nevada. We are looking at further automation, reposition, and the other thing is, you saw us invest in a whole lot of new equipment, mobile equipment particularly. We are running a trial on automation, which we will then roll out across the complex. And we've also challenged the management on parking up equipment, because every time you have you don't use the equipment efficiently, you end up with 2 operators, and that means 2 operators, it means 6 operators. And so you take out a piece of equipment and suddenly you have that requirement, and you can reallocate those people to different positions. So we have a training mine now for underground miners, for open pit miners, and for processing. And we could do with a little more capacity, which we are investing in. We're expanding that capability, because in the US, the concept of technical skills is not the same as in Europe and the colonies or ex-colonies like South Africa and Australia. And so what we're doing is building that skill into the workforce. And during COVID, we got to a 25% turnover rate. We're way back down now. And again, as we've rotated out the people, our retention of workers that go through the training mines are very high, in the 90s. Because as you can imagine, you go into a big operation like Nevada, and you're not fully trained to operate in these big underground mines or these huge open pits. It's hard to do, but when you know what to do and you're well trained, then the job is so much easier. So our investment in people has been, and the other thing, it's with the lithium market now collapsed, because we also the source of all highly qualified miners in the USA, because we are the biggest miner in the USA. So that pressure has come off, and I think as you see, and as we have got Nevada to perform, of course you keep people then too. People don't leave when you're starting to perform. So all around, Nevada is in a very different place, and it has been changing all the time as we work to make it an owner-led style of business rather than a corporation, which it used to be.
Mark, Steve Green, TD Securities. Just to stay on 4 Mile, you mentioned that you intend to be in a position to give pre-fees options by year end, or have pre-fees options. Does that mean you intend to update the market with pre-fees level numbers like CapEx and size, therefore?
Sure. More options now. Right now is access, because the one thing about Gold Rush is the accessibility. The twin declines were exploration declines, which you made into operational declines now, and that they daylight halfway up a hill. And what you want is, if you're going to put in access to ore bodies that are underneath a mountain, you should try and get it at the valley level. And so, we're looking at different options. Can we access from Cortez itself? There's an option there. Can we access it from the north where the metallurgical infrastructure is? And what is it? What's the most optimum way to integrate 4 Mile's infrastructure with Gold Rush's infrastructure, because it's a continuation of the same ore body. What makes 4 Mile is that it's in a big metamorphic halo, so it's brittle. And so the style of mineralization has changed to a breccia, the classic Carlin breccia, which is bigger, bulkier, higher grade. It's interesting. We're also getting some of these flatter, planar ore bodies occurring as well, which is what we didn't expect. But it's a very interesting. For me, even watching it evolve, when you look at that section, that section really does tell you how connected the geology has become as we've drilled these holes. So it's a really exciting ore body, not to be underestimated at all.
So presumably you'll want to let this play out for a while before making a decision on vending it in.
I've always, as you know, I'm a very open, transparent person. So, we own it, as Graham says. It makes sense for to access, and it has the right to Nevada infrastructure, and the conversation will continue in a transparent way. And when we feel that we get to something, if we do, that's of value, proper value, we'll make that decision. But to your point, we've got a way to go before we get there. And the first thing is to try and get a grip of exactly how big this prospect is.
Thanks.
Mark, Anita again. You made a comment when you were talking about the 4 Mile vend-in that as long as a joint venture meets a return on invested capital, did you mean the 4 Mile meaning the return on invested capital, or the joint venture itself, the whole Nevada Gold Mines?
No, it's just the 4 Mile, and it's a specific number. Okay. It's a blended number. I can't remember the actual number. What's it?
The IRR. The IRR is a 15% IRR.
15%, but
effectively using a
gold prices are backward-looking.
It's a combination of 2-year history, spot, and consensus.
It will not struggle to meet that hurdle, I promise you. Okay, can we leave this room and move to the call? Okay, operator, over to you.
Thank you. To join the question queue, you may press star and 1 on your telephone keypad. You will hear a tone acknowledging your request. If you're using a speakerphone, please pick up your handset before pressing any keys. To withdraw. Daniel Major with UBS. Please go ahead.
Hi, Mark. Hi, Graham. Can you hear me okay?
Hello, Daniel. I can hear you.
Hi. Yeah, thanks for the questions. Yeah, a couple of questions. The first one on the cost profile in Nevada. Obviously, it's been a number of questions on it already, but just to be clear, is the main delta in Turquoise Ridge, it looks like that unit cost needs to come down a lot, but is that the main delta to get towards, back into the guidance range as you've completed the autoclave maintenance and the backfill infrastructure? Is that the main moving part?
Yeah, I think Turquoise Ridge, the autoclave maintenance is in good shape now. The process is, good. I think the all-in sustaining cost drivers are still extra infrastructure and backfill that we're putting in right now, sustaining capital. And so that'll come off, and you're right. Once we get that mining rate done, and that's, Turquoise Ridge got a big, you just do the math. The numbers the production increase is quite high, and that will definitely drive the unit costs down. So that's really the big driver in Turquoise Ridge. Graham?
Okay, thanks.
Yeah,
Dan, Graham's going to add something.
Just to confirm, so the key assets are Carla and Turquoise Ridge, and then, of course, Pueblo Viejo. That's also another key driver on costs for the year.
Cool, thanks. And the second question I had on tax, you recognize 137 million sort of tax adjustment around proposed settlements in Chile. Are they expected to convert into a cash payment at some point? Can you just give us any cash implications around that tax charge you recognized?
Yeah, thanks, Dan. Yes, that's correct. Yeah, so this relates to the sale of the Zaldivar asset in 2015. As we've disclosed for some time now, we have been in discussions with the government there on the interpretation that they had, which was for a claim that was significantly higher. We've now reached a in principle agreement to settle that. We're busy finalizing that agreement, which we expect to get done in the third quarter. So yes, that should translate into a cash payment this year.
And Dan, I think it's a very good point you make. Where, if you go back to 2019, when we looked at this business, it had lots of challenges to it. Tanzania wasn't operating, Argentina was under threat, Papua New Guinea was, trying to get its renewals. Ricka Dick was in arbitration. We had Chile, and then we had a pile of closure assets as well that were just being kicked down the road. And where we are today is that, we've, as I've always done in my career, deal with the liabilities, and then you free up, and there's no better time to deal with the liabilities when you've got big commodity prices. So we've really focused on those liabilities, and we're on top of them. We've done our first 2 safe closure tailings facilities or closure sites. We're going to do another 8 this year, or that's the target, 6 to 8 closure sites, safe closure. And Perina comes to full closure early next year, and we've engineered that. And so one of my focuses is the non-operating costs within the organization, and we're driving those costs down, and that really drives the margin. And I took a position that we're not going to kick that down the road. And when you stack up Barrick to its peers, we are on the road, on the trajectory to have very little liabilities associated with non-operating assets. And that's a focus that we've always had. So again, in the mix, let me just remind you, we didn't pay a premium for any of the assets we've talked about today. We've got very significant assets, which I've shared with you again. We've got operating assets on top of that, which are significant with life of mine and margin opportunity. We have dealt with the challenges. We've got all the mines up and running. Porgera is, we turned on the last of the autoclaves last week. So all the autoclaves are operating in Porgera. And we've got a couple of non-core assets that, we might or might not bring to account over the next short while. And then we have been dealing with these liabilities, Chile, of course, and Chile is rapidly becoming an opportunity as we deal with those legacy issues, both in the form of Pascua-Lama and Zaldívar. And then Peru, Perina, that's a big chunk of non-operating costs that'll come out of our cash flow or our cost flow. And so, my view is that, into next year, we're a different company again, as we were from 23 to 24. And very quickly you've got, and that's why this quarter is so significant, because you got a flat cost. And we caught all the margin in the commodity price, which is that's the first step in our future strategy, and that is to sweat these assets. And as soon as you get on top of that, you can manage the investment in those closure sites. So you can, we are compliant with GISTM. We've got nothing that's, dangerous in our portfolio. And so we can start managing our non-operating costs as we go forward. So that's where the company is today.
Great, thanks. And just one more, if I could, and it's just coming back to the discussion on the buyback and the dividend. I totally understand the opportunistic logic of the 50 million, but if we look at go-forward basis, should we just assume that you're going to be opportunistic, but from a modelling standpoint, let you run the balance sheet down towards a net cash position before factoring any kind of meaningful additional buybacks in the second half?
No, we are going to be buying back on a considered fashion, building on what we did last quarter. And so we'll manage it. Graham and I'll manage it. We have got, we share the strategy with our board. Everyone's happy with what our plans are. And at the same time, we're mindful of a demand as we go into a capital intense phase. And again, we can manage all that within our balance sheet. So we don't want to get to and the one thing, Dan, that we've always done is stuck to our own rules. Some of our peers don't do that. They say one thing, do another. But we are very clear about how we allocate capital. As a management team, we reflect on it every week. We look at ways to be able to intervene through my career, I've had to deal with a number of short positions in a stock, and I don't think there are not too many people who would take a big short position in Barrick today. Do you want to add to that, Graham?
Yeah, I mean, and just to reiterate, we have an exceptionally strong balance sheet, notwithstanding that we've got these big capital growth projects ahead of us. And that's the position we like to maintain. But even if we do continue to buy back shares, as Mark says, on a measured basis, we'll continue to have very low debt to EBITDA ratios by any metric. So we are afforded the opportunity to take advantage of what we see as exceptionally good value in the stock, but still on a very measured basis.
Very clear. Thanks a lot.
The next question comes from Bob Brackett with Bernstein Research. Please go ahead.
Good morning. Just a couple questions related to the feasibility studies that we're looking forward to seeing by the end of the year. Anything you can tease on those feasibility studies? In the MD&A, you talked about the approximately $2 billion of capex around Lumwana at 50 million tons of processing. Anything to say around Reko Diq, and what are the things that that would worry you between now and the release of the feasibility studies in terms of moving these projects forward?
So I would say, if you don't worry about capital projects, they always go wrong. So, and many times if you worry about it and do nothing, then they also go wrong. So, but Lumwana is in a good place. And you know, and Lumwana washes its face at the expansion at $3 a pound. So it's, you know, there are not many copper assets that do that. And as you know, the copper industry has been saying, jack the copper price up, and we'll develop our assets. And so, and that's an expansion. You know, we've got the one circuit. We're effectively duplicating that circuit. And so we don't see the big focus on Lumwana is the fleet and the efficiency of mining and the cost of mining. That's our focus. And we've got a new fleet. We'll be expanding that fleet. And everything that we're monitoring at the moment, we're comfortable with our assumptions. And then on Reko Diq, you know, right now we are in the final negotiations of long lead items, looking at numbers. And there's no material change in our original estimate. By the way, we're going to do a webinar on Lumwana in 11th of September to share sort of some color on Lumwana, as we did with Reko Diq. And that'll free us up to spend a little bit more time on Reko Diq at the Investor Day in November. So, but on Reko Diq too, is, you know, there's been swings and roundabouts. We've made very good progress with our water strategy, our infrastructural strategy. Graham's progressing the financing options. You know, I think everything is, there's nothing there that's not in line with our original assumptions that we shared with you going forward. Do you want to add to that?
Yeah, no, I think that's a good summary. I mean, there are some, what I would call design changes that have come through the feasibility, as you would expect. So, for example, yeah, we're compared to the original feasibility, we're anticipating using rail, and so there's infrastructure associated with that, but there are also benefits of that coming through in the financial model. So all of that will be showcased at the end of the year when we complete the feasibility study.
But we're going to do a good update in September. You'll get some color on it.
Yeah. So
sorry, that's in Lumwana.
Lumwana will be September, and then obviously with the Investor Day in November, there'll be some more color there, and the final feasibility will come out in the beginning of the new year.
Anita. We have a mark there.
Just wanted to ask follow-up on 4 Mile. What kind of drill density are you looking for to get to the indicated and the inferred categories by year end?
Oh, no, we're not going to be there by year end. So we'll be some of the way there, but not full. I'm not sure we can answer that question yet. Simon, do you want to add to that? What drill density? I think we know where we've got to get to, but that's still some time off. That's a pre-feed.
Yeah, we know what we're targeting. So for indicated, we'd be targeting in the region of 70 to 75 meters based on the current geological models, but that's being reviewed through the course of the preliminary economic assessment at the moment. The update we're targeting for the year end will really be an inferred resource update and a view on the larger potential of the project, and as well as narrowing down, as Mark was alluding to earlier, some of the different options that we will focus on within the pre-feasibility study.
Anybody else on the telephone? 2 more.
The next question comes from Mike Parkin with National Bank. Please go ahead.
Hi, guys. Thanks for taking my question. Congrats on the good quarter. Just a question on the Pueblo Viejo relocation work. It seems like everything's off to a good start. You've got quite a few things going on. could you just remind us what is the critical path there? Is it finishing the town and relocating the peoples, or is there something else that's kind of the main item to stay two eyes on?
So, of course, the preference is to relocate the key communities up front so that you don't end up trying to do heavy earthworks and have communities, moving through or around the footprint. And so I was there just the other day. We've got a couple of hundred houses now in construction, and we're adding to them all the time. We are working with the communities, and we'll relocate the communities on a priority basis. And that's really moving people from sort of rural areas into an urban situation, and with it comes food security, and so it's quite a complex, and it comes with schools and community centers and everything else that goes in a integrated community. The geotech, the next step in this process is the completion of the feasibility of the dam itself, and that's due this quarter. So that'll be the next big step. Right now, we're expecting to bring the dam into production at the back end of 2027, early 2028. So that's, we're still well within our plans, and right now there's no emerging critical path. I think everything is, as in this phase of a capital project, everything's assumed critical.
So are you having any issues with suddenly new regional residents, trying to capitalize on getting a new house, like we've heard in the past in other certain situations, mostly in Africa? Any kind of activity there, or do you guys have a pretty good sense of, do some sort of paperwork to know who you have to deal with versus some of the people trying to be strategically advantageous of the situation?
So, Mike, we always have that. You have people who exploit the opportunity. Nowadays, satellite imagery is very helpful in managing who was there and who wasn't. It's pretty hard to lie with to deny a picture. I think, but it's part of the whole social engagement is dealing with, people who exploit the situation, who take the opportunity to sort of claim things, and we work with that all the time. It's, this is a community we're going to live with for a very long time. So we manage that. The positive side of where we are today, as you know, we went through a very extensive process to select the site with government, with the civil society, with the Catholic Church, the whole Cote. And under the lease agreement that we operate Pueblo Viejo in, is the government has a responsibility to participate in the relocation and payment thereof. So it's a joint process. But right now, it's our community people that are working with the relocation committees that are set up for each community, and then various other authorities, and from time to time, as you point out, other people who are wanting to participate in the benefits.
All right. Thanks very much, Mark.
The next question comes from Tanya Jakusconek with Scotiabank. Please go ahead.
Oh, goody. Thank you for taking my questions. Good afternoon, everyone.
Hello, Tanya.
I just wanted to come back to just how the rest of the year, evolves, and I just wanted to make sure I understood correctly. So just on the Nevada gold mines, which is going to be driven by Carlin, better grades, and Turquoise Ridge as well with better grades, am I to assume that the volume is going to come by you processing those higher grade stockpiles at Turquoise Ridge as you've worked on the paste fill in the underground, and then the cost reduction also comes in not only volume but due to the elimination of the contract workers as you go into self-mining? Is that a correct understanding?
Broadly, yes. Yes, broadly. The throughput is not, it gets tempered because what drives the grade is underground and less open pit ore. So that impacts the throughput numbers as well. But broadly, you're right. It's really a grade. Talking about Carlin and Turquoise Ridge in particular.
Okay. And have you seen the pickup? Because it's a month and a half now into the quarter, into Q3. Have you seen the pickup in the grade?
Sure.
Okay. Thank you for that. And just similarly at Pueblo Viejo, I just want to make sure I understand. And thank you so much for that slide with the 78% recovery. I'm just looking at it right now. 79 into Q3 and then 80 into Q4. Have you said you've got the throughput where you need it to be, and you're just working on the grind portion and the recovery? Again, a month and a half into the quarter. Are you seeing that recovery?
Yes, I think I would say that, Tanya, as you know, we're seeing it more than we're not seeing it. So it's still very much part of, this is a refinement. I think that's what we got to get across. This is not a magic box. This is SAG milling at its most challenging. We've got a very big single SAG mill that's joined a SAG ball mill flow sheet. And we've just settled with the construction of the new conveyor belt, so we've got the extra crushing capacity. And now it's about making sure that we get the grind parameters right. And when we get the grind right, we get the float right. When we get the float right, we can feed the autoclaves appropriately, and the whole flow sheet logic of PV is to increase the sulfur content of the feed into the autoclaves, which really drives the fuel content, and that drives the oxidation. And what we have done in the interim, which I shared last time, is we did create a variance to that, so we can still feed run-of-mine ore into some of the autoclaves. We can reconfigure them to take run-of-mine ore. But it's really about the grind size that we've got to work harder on, and that's all about the control, the processing control that we've put into the milling and screening side of the flow sheet. So it's really technical, bedding down the operation. But what we can tell you is that we've certainly had runs where everything works, and we get right up there on a unit per hour basis that we need to get on a consistent basis, and then we'll meet our objectives. And without a doubt, my whole career, I've been through these processes. They're frustrating and stressful, but at the end of the day, we get to where we want to get to.
Yeah, and just on something that Anita had mentioned, the 92% recovery, and I know that you're corrected us on the 86%, but I was under the assumption as well that we were getting to 92. Just wondering if it's just our recollection from the mine tour or something has changed. Just some clarity on that would be great. Thank you.
Hi, Tanya, it's Graham. You are correct that in the feasibility 43-101, we do go up to the 90s. It's a graduated process, so it takes us a while to get up there.
Okay, so the aim, Graham, is still to get there. It's just not really over the next few years. Is that correct, sir?
Yeah, definitely not this year, as we pointed out.
Do we get there next year?
No, the following year.
Following year. Okay, thank you on that as well. And if I could ask about, Mark, I always ask about reserve replacement. I always like to know what, how we look going forward. So as you're 8 months into the year, how does reserve replacement look for you this year? Both from a mine site perspective versus resource, and then the critical question of, with this gold price at 2,400 plus, is there the thought of having to change your reserve and resource pricing?
So I'll answer the easy part of that question and then pass on to Simon Bottoms to do the detail. Where we are at the moment is with the two big feasibility studies, we more than replace our reserves and resources. These are big numbers, both in gold and in copper, coming out of Reko Diq and the Lumwana Super Pit. Having said that, the Kibali, Lulaga, and Cote are also in good shape to replace. PV is slightly. PV, we added that we took the reserves to 21 million ounces last year, so that's a big number. And although the geologists are pointing to additional opportunities, it's not going to come in. And the big focus right now in Papua New Guinea is really getting the mine up and running. We've got a 10-year life of mine. There's work to do to be able to add additional reserves to that life of mine. And so those, just on a broad level, that's the sort of the way we look at it. Simon, do you want to pick up on that?
Yeah, sure. So as Mark said, so for the year, Africa, Middle East is looking positive to replace its overall regional depletion. Again, it's, as we've already pointed out in some of the releases, it's really driven by those core tier 1 assets, Lulo, Kibali. But we're still seeing strong indications that we will be able to continue that fate in Tanzania as well. The Latin America region, the assets aren't all forecast to fully replace their depletion this year, but with the addition of Reko Diq, as Mark's already said, that is forecast to make a substantial growth to that region. Within North America, for Nevada Gold Mines, again, we're currently working through the models, but we are forecasting to replace our depletion within NGM, particularly, and with updates to the open pit studies, particularly in Hemlet. Then for reserve pricing, we are seeing some cost pressures. We're looking at the pricing at the moment. We're doing the studies, and we'll be looking to announce later in the year where we stand with that. But our intention, as has always been, is to maintain the quality of our mine plans, and because a lot of our mine plans are more geologically constrained, whereby we even with the current reserve price, we actually mine the majority of the high quality, high grade material. So when you lift that reserve price, you inherently just add marginal material, and so therefore we evaluate it on a asset by asset basis, and to ensure that any increases in or change in reserve price would add material that would actually drive value and not just bring extra capital requirements through additional process plant expansion requirements. Resource pricing, I think we reviewed our resource price for copper last year, and that's still very much in line with long-term consensus at the moment. And I'd expect we'll be looking at our long-term resource pricing this year.
Thanks, Simon.
I really appreciate that, and thank you very much for taking my question.
Pleasure. Anita.
One follow-up to that.
Yeah.
The last question comes from Daniel Major with UBS. Please go ahead.
Hi. Thanks for the follow-up. Just couple of quick ones, more modeling dynamics. It looks like G&A, perhaps exploration is running a little bit below your guidance. Obviously, a good result if you're pulling the G&A down. How should we be thinking about that? Should we expect a big step up in the second half, or are you undershooting the 180 million, particularly on the G&A? And similar question on the exploration and project.
So we pride ourselves in being the most efficient operators of a mining company on this planet when it comes to G&A, and we continue to look at making our corporate oversight as efficient as possible, and we will continue to do that. So that trend is a good trend, and it's interesting when you see what we do with twice the size of the company, and with less people but super efficient systems. That's what we stand for. So that trend is right. And then, Dan, I've tightened up on the exploration a bit this year. Just we had got to a stage where, my resource triangle, we were getting sloppy with the resource triangle. We needed to tighten up people's priorities and not just lump more and more targets into the resource triangle, and needed to be properly tested. And so we tightened up on the budget and said, the budget's available, but you've got to pass some filters to get more. And it just needed that discipline, and that's what we did. So again, you've picked up very smartly a little tightening in the way we're allocating exploration dollars. We've got a lot of opportunities. We've got to get the geologists and the evaluators to be a little bit more focused on moving the portfolio up through towards feasibility study, and that's the reason that we've just tightened up.
Thanks very much.
Mark.
Anita, you got...
Yeah, it was the follow-up on the reserve gold price question. So I recognize that you don't want to, erode your margins on the one side, but on the other side of the equation, I think you can, inflation is obviously persistent. One of the reasons why we have a gold price that's at $2,400 gold. So, would you consider raising it to make sure that you're capturing all of the value given the current costs?
So this is a very interesting topic. I'll try and keep it short. So first of all, the gold price is up because the world's in a mess, not because of inflation. Inflation is part of that mess. So we worry about long term. That's why we keep discipline on our the reserve price. And there is a time when you start eroding your ore bodies with the gold price because of the cost issue, and that's when we moved to $1,300. That was the reason. We found the right balance between Barrick and Randgold assets, and to Simon's point, we looked at the ore body shapes. So when you take a higher gold price into an ore, and we mine quality ore bodies. So when you take Turquoise Ridge, you go in and you jack the gold price up, you start mining waste. You start mining very marginal ore, putting it into the mill. That means to keep the same production, you've got to enlarge your mill, and thereby you increase your costs, and your value of your asset goes down. So all the mine management every year have to deliver an NAV equation on their business and why they think they should be doing something different if it detracts from the inherent value of the operation. And we have very few assets that are higher gold. There is logic for a small increase in the gold price, which effectively keeps your grade, so it keeps your ore bodies intact. Because the last thing you want to do is start slicing a piece of your natural boundary of your ore body off. The other side of it is, for instance, Tongon, you'll see we changed that gold price that we look at Tongon because it's a closing mine and we don't want to leave value behind. And the ore bodies are such that we've started building capacity in the processing facility so it can take that marginal ore and still make money out of it. So each one of our operations we assess independently. And Simon's absolutely right. What we did do on the $1,700 gold price is we looked at the ore bodies, particularly the low-grade pits and that, and we said we don't want to compromise our shareholders' future potential by putting infrastructure on the ore bodies. So we used 1,700. 1,700 pretty well mined out our resource. And so that's the logic for a big gap. It's quite interesting now at 2,400, the 1,700 actually looks quite attractive. But the capital to take that forward is high. Certainly the oxides we are taking already. We will take oxides on the margin, particularly in Nevada, because we've got capacity. So just to give you a feel of how we manage our portfolio. Beanie wants to say something.
I was just going to add that, effectively, Anita, we do take cognizant of that inflationary impact. And obviously, if we see it as a sustained increase in costs, and as Mark says, it's going to erode the core value of those ore bodies, then we would adjust for it. So it's something we look at. We keep it under review. The teams are busy with that work, as you would expect now, and we'll see whether it's necessary or not. But right now we're pretty close to where we need to be.
Anything else? All right, ladies and gentlemen.
No more questions.
Okay, operator, you good your side?
Yes, there are no more questions.
Thank you very much. Thank you, operator, for managing this, and thank you everyone for coming. There's some snacks next door for those who want to hang around. And I would just say, there were some detailed questions coming out. We sort of did a bit of a modeling session here. You are always welcome to reach out to our team, whoever you feel comfortable reaching out to. We're always there to share the detail with you and get you on the right track. So please feel free to reach out after this. Thank you again for making the time.